Jeff, we have to explain the financial implications when someone pays cash for their home. In exploring this idea, we need you to really think deeper financially than maybe you ever had to before.
Yeah, when something is outside the box, then you have two options. You either kick it to the curb or you get a bigger box.
We're asking you to get a bigger box, but let us prove to you why.
The lessons of lost opportunity costs, liquidity, use, and control, and the Rule of 72 must be applied to your thinking. If you're not familiar with the Rule of 72, it's pretty simple. It's just math. If you get a 7.2% rate of return, then your money will double in 10 years. If you get a 10% rate of return, then your money will double every 7.2 years. That's all it means.
Most people think that they will save interest by selecting a shorter loan period like a 15-year mortgage. With that in mind, then paying cash for your home would save the most interest that would have normally been given to the bank.
It sure sounds right, Kelly. The problem is, by paying cash, you no longer have that money to invest. So you are losing earnings that you could have made from that money, otherwise known as lost opportunity cost.
Also, if cash is paid for the house, you forfeit the tax benefits on the interest deduction. By using the tax deduction, you can recapture dollars, which you couldn't do had you paid cash. However, it doesn't make sense to pay $10 in interest just to save $3 in taxes.
For sure, Kelly. But this here is a deep thought when it comes to mortgages. Ready? You must understand that it costs you the same amount of money to live in your house whether you have a mortgage or you pay cash. Let's take a look.
If you have a mortgage of $150,000 at 7% for 30 years, the monthly payment would be $997. If the monthly payment was invested for 30 years at 7%, it would equal $1,217,475.
Rather than paying $150,000 cash for the house, you invested it instead at 7% for 30 years. Keep in mind, there are gurus on cable TV that say you can average 8 to 12%, so this shouldn't be hard, right? It would grow to $1,217,475. Presto, it's the same number, Kelly.
Both of these scenarios are examples of transfers. Whether you paid cash for your home or are making payments through a mortgage, it is costing you money.
The difference is that in the case of the 30-year mortgage at 7%, the mortgage would yield about $60,000 in tax savings in that 30-year period for someone in a 30% tax bracket.
But the mortgage calculation doesn't end there.
Not even close. There's also opportunity cost on that 60 grand. You see, this is exactly what we mean when we say our goal is to recapture some of your wealth transfers.
Get ready for more financial caffeine. It's coming.
I'm Jeff.
And I'm Kelly, and we're your financial heroes.